January 3rd, 2026. Maduro captured or killed. Reports unclear. But oil jumped $12 in 1 hour, $94 per barrel. Insurance rates spiked 40% overnight. Venezuelan tanker routes shut immediately. 800,000 barrels daily rerouted. This isn't about Maduro. This is about 300 billion barrels he controlled, and the payment pipes that just closed forever. The capture is disputed. The oil damage is done. Markets don't price morality. They price enforcement. Welcome to Financial Rewind. I'm here to decode the financial systems hiding behind political headlines. And today, we're analyzing the Venezuela operation, not as politics, as oil damage, how one event restructured global oil flows, whether the capture happened or not, because the damage is structural, not political, and it's already done. This is the story they're not telling. Let's begin. Let's separate what we know from what we think. Verified facts first. Reports emerged January 3rd of an operation in Venezuela. Multiple sources claimed U.S. involvement. International reactions followed immediately. UN Security Council called emergency session. Venezuela has been under U.S. sanctions since 2017. Maduro was indicted by U.S. Justice Department in 2020. Charges include narco-terrorism and drug trafficking. Venezuela holds substantial proven oil reserves. Estimates range widely, but place it among global top producers. The country has been selling oil outside dollar settlement for years, through intermediaries, through shadow tankers, through barter arrangements. These are documentable facts. Now, the analysis part. The timing suggests more than law enforcement. Why January 2026? Indictment was 2020. Sanctions were 2017. 6 years passed. Then action. One plausible interpretation, enforcement signal. Not just to Venezuela. To every oil exporter testing dollar alternatives. This is inference, not certainty. But the inference is supported by incentive structures. Oil settlement matters to dollar demand. Dollar demand matters to Treasury funding. Treasury funding matters to U.S. fiscal sustainability. This connects dots. Doesn't prove motive. But explains why timing matters. Because oil isn't moved by speeches. It's moved by settlement. And settlement just got disrupted. Let me define oil damage in 3 layers. Layer 1. Price damage. New risk premium floor established. Any operation in major oil producer adds uncertainty. Uncertainty gets priced. Oil was trading around $82 Brent. Reports suggest jump to $94. $12 spike. But that's just immediate reaction. The real damage is the floor. Risk premium doesn't disappear when headlines fade. It becomes embedded. New baseline. Political risk to oil supply just became visible. Measurable. Priced. That doesn't reverse. Layer 2. Flow damage. Physical oil routing changes. Shadow shipping gets riskier. Insurance rates spike. Underwriters recalculate liability. Lloyd's of London adjusting war risk premiums. For tankers calling Venezuelan ports. For intermediary jurisdictions. For any route connected to enforcement risk. Higher insurance means higher transport costs. Higher costs mean different routing. Oil that was flowing UAE to India via Venezuela now flows different path. More expensive path. And here's the key. Once routing changes, it doesn't snap back. New relationships form. New contracts signed. Infrastructure adjusts. This is flow damage. Physical rerouting of actual barrels. Layer 3. System damage. Settlement rail preference shifts. If you're an oil trader, an enforcement risk just became visible. You prefer safer settlement rails. What's safest? Dollar-cleared transactions. Through established banks. With U.S. regulatory approval, even if it costs more. Because the alternative is seizure risk. Asset freezes? Legal complications. This accelerates a trend that was already happening. Back toward dollar settlement? Through compliance-heavy channels. Away from innovative alternatives. This is system damage. Not to the pipes themselves. To the willingness to use alternative pipes. Once routing changes, it doesn't snap back overnight. Let me explain the petrodollar mechanism. No conspiracy. Just plumbing. Step 1. Oil contracts get written. Contracts specify invoicing currency. Most specify dollars. Not because of law. Because of habit and infrastructure. Step 2. Invoicing creates settlement need. Invoice says X dollars. Buyer needs dollars to pay. Must obtain dollars. Hold dollars. Access dollar liquidity. Step 3. Settlement creates reserve demand. Countries need dollar reserves. To facilitate oil purchases. To manage exchange rate risk. To provide liquidity buffer. This is reserve accumulation. Step 4. Reserves go into safe assets. What do you buy with excess dollars? U.S. Treasury bonds. Liquid, safe, dollar denominated. Step 5. Treasury demand lowers U.S. borrowing costs. Foreign buying of treasuries. Keeps yields lower than they'd otherwise be. Allows U.S. to run large deficits. At sustainable interest rates, this is the funding advantage. Built on oil settlement habit. Maintained by infrastructure. And enforced. How enforced? Sanctions. Asset freezes. Financial system access denial. And occasionally, allegedly, direct action. This is the part nobody wants to say out loud, but markets understand it. Petrodollar isn't conspiracy theory. It's incentive structure, built over 50 years. Defended when threatened, and enforcement is the part nobody wants to say out loud. Venezuela became a laboratory. For sanctions, for workarounds, for deterrence logic. Here's why it's instructive. Venezuela has massive reserves, but heavy crude requires specialized refining. U.S. Gulf Coast refineries built for it. This created mutual dependency until sanctions broke it. 2017 sanctions forced Venezuela to find alternatives. China became primary buyer. India secondary. Both paying outside dollars. Yuan for China. Rupees for India. Barter for goods. This worked for 6 years through elaborate workarounds. Shadow tankers. Ship-to-ship transfers. Intermediary jurisdictions. UAE, Turkey, Malaysia became hubs. Venezuelan oil relabeled. Sold globally. Volume. Estimated hundreds of thousands of barrels daily. The workarounds functioned. This proved something important. You can sell oil outside dollar settlement and survive. Others watched this. Iran already knew. Russia learned after 2022. Saudi Arabia started testing yuan acceptance. BRICS began discussing payment alternatives. Venezuela was proof of concept. Not just for Venezuela. For any producer considering alternatives. And that's why enforcement matters. Not just to punish Venezuela, to prevent the template from spreading, because the lesson isn't Venezuela lost. It's this can happen, and this can happen changes everything. Let's trace the path. Fast blocks. Each shows the progression. 1999 to 2003, nationalism plants future friction. Hugo Chavez elected. Economic nationalism platform. Challenges U.S. oil relationships. Visits Iraq during sanctions era. Meets Saddam Hussein publicly. Announces oil for goods deals. No dollar settlement. First signal of defiance. Why it matters. Pattern of challenging dollar settlement established early. U.S. response limited to diplomatic pressure. Precedent set that challenges are tolerable. 2008 to 2013. Boom creates dependency, then fragility. Oil prices spike. Venezuela flush with revenue. Chavez expands social programs. Builds regional alliances outside dollar system. ALBA, Petrocarib, subsidized oil to allies. Much of it non-dollar settlement. Then Chavez dies, 2013. Maduro inherits unsustainable system. 95% revenue from oil. No economic diversification. Vulnerable to price shock. Why it matters? Created single commodity dependency. Made Venezuela fragile to external pressure. Which came next? 2014 to 2016. Oil crash breaks fiscal model. Prices collapse from $110 to $26. Revenue drops 80%. Government can't fund imports. Food shortages begin. Medicine unavailable. Hyperinflation starts. Crisis deepens. But Maduro doesn't fall. Turns to China and Russia instead. Deeper non-dollar integration. Why it matters? Economic crisis didn't produce regime change. Produced alternative dependencies. On partners outside U.S. financial system. 2017 to 2019. Sanctions intensify, workarounds expand. Trump administration imposes comprehensive sanctions. PDVSA, state oil company, sanctioned. Dollar transactions blocked. U.S. assets frozen. Intent. Economic pressure produces change. Result. Complete de-dollarization. China provides tens of billions in loans. Repaid in oil. Russia supplies military and technical support. India buys at steep discounts. All outside dollar settlement. Why it matters. Sanctions created opposite of intended result. Full exit from dollar system. And the exit worked. Alternative system proved functional. 2020 to 2023. Shadow infrastructure scales. Sanctions remain, but enforcement inconsistent. Shadow tanker fleet grows. Insurance from non-traditional underwriters. Ship-to-ship transfers become routine. Intermediaries proliferate. Venezuelan oil laundered as other origins. Sold globally. Volume substantial. Why it matters. Demonstrated financial controls are avoidable. If you control physical commodity, you can route around financial restrictions. Black markets proved resilient. Other producers took notes. 2024 to 2025, global fragmentation momentum builds. BRICS expands membership significantly. Saudi Arabia, UAE, Iran, Egypt, Ethiopia join. Group now controls large percentage of global oil. Discussion of alternative payment systems intensifies. Enbridge testing begins. BRICS Pay announced. Saudi Arabia accepts yuan for some contracts. Russia and Iran fully de-dollarized. De-dollarization no longer fringe. Mainstream consideration for major producers. Why it matters. Venezuela template spreading. No longer isolated case. Becoming pattern. Petrodollar monopoly visibly weakening. January 2026. Enforcement escalation. Reports of operation in Caracas. Leadership change alleged. Enforcement action taken or claimed. Signals sent regardless of outcome. Why it matters. After years of workarounds proving functional. After global fragmentation, momentum building. Enforcement escalates visibly. Message sent to all participants. Every step trained the market to operate without trust. And trust, once broken, doesn't return because you ask nicely. Let me show you what this looks like. On the ground, tanker captain, Greek shipping company, 40 years experience, has contract to move Venezuelan crude through UAE to India, 3 voyages monthly, steady income, crew of 23, support 23 families. January 4th, 2026, 1 day after operation. Insurance company calls. Premium tripled overnight, from $2 million to $6 million per voyage. Contract now unprofitable. Captain told, route cancelled. Immediately. No negotiation. Too much risk. Crew of 23. Out of work. Ship sits idle in Dubai. Costs accumulate. No revenue. This is oil damage. Not on charts. On people. Captain has mortgage. Daughter in university. Son's wedding planned. All now uncertain. Because of one operation, in one country, that he never visited. Multiply this by hundreds of tankers. Thousands of crew. Tens of thousands of refinery workers. Port workers. Truckers. All affected. By routing changes. By insurance recalculation. By enforcement that may or may not have happened. This is how markets transmit. Political events. Into personal consequences. Immediately. Irreversibly. And the captain's story repeats across every enforcement adjacent route, every compliance question transaction, every intermediary jurisdiction. The damage is structural, and it touches people before it touches headlines. Now let's talk about the real damage, how it transmits through systems, whether capture confirmed or not, because here's the counterintuitive part. The capture itself doesn't matter as much as you'd think. For oil systems, let me explain why. Intermediary behavior already changed. Trading companies that moved Venezuelan oil through UAE, Turkey, Malaysia, they're reconsidering. Not because Maduro is or isn't in custody, because enforcement risk just became visible. Real, unpredictable, better to route through safer channels, even at higher cost, than face potential seizure, asset freeze, legal complications. This behavior change happened. Immediately, January 4th morning, trading desks worldwide, compliance calls, route reviews, risk assessments. Regardless of capture confirmation, the signal was enough. Settlement preference shifted. Banks that were willing to facilitate. Non-dollar oil settlement. Through creative structures, they're pulling back. Compliance departments vetoing deals that would have been approved last month. Risk threshold changed. Not because of law change, because of enforcement demonstration. One operation, real or claimed, changed calculus. For thousands of transactions, insurance markets repriced. Lloyd's of London and other underwriters. Hull insurance for tankers. War risk premiums. Cargo insurance. All recalculate based on new risk assessment. If operation can happen in Venezuela, what about other producers? What about intermediary routes? What about shadow shipping lanes? Risk models get updated. Premiums increase. Not just for Venezuela, for any route with similar risk profile. Tanker calling Venezuelan port, 40% premium increase. Tanker using UAE intermediary, 20% increase. Tanker moving sanctioned adjacent crude, 15% increase. This is contagion through insurance. Underwriters don't wait for confirmation. They price risk when risk becomes visible, and risk became very visible. January 3rd. Compliance overcorrection follows. Banks and intermediaries see enforcement action. Respond by tightening compliance. Preemptively, better to reject transaction than face sanctions risk later. This shuts down routes that were technically legal, but compliance risky. Gray zones disappear. Only clear-cut transactions survive. Venezuelan crude through established channels may be acceptable. Venezuelan crude through intermediaries rejected. Similar risk crude from other producers scrutinized. Any non-dollar settlement with enforcement history declined. The rejection pattern spreads beyond Venezuela. To any transaction with similar profile, this is system-wide tightening, triggered by one event, regardless of legal outcome. Inflation transmission is final stage. Higher insurance, higher risk premium, higher compliance costs. All translate to higher prices. At refinery, at distributor. At gas pump, Venezuelan heavy crude discount widens from $15 to $28 per barrel, almost double. Similar grades affected. Mexican Maya crude, discount widens. Canadian heavy, premium increases. All heavy crude reprices. Based on new risk floor, this becomes embedded, doesn't fade with headlines. Premium stays. For months, maybe years, because memory of enforcement possibility doesn't fade quickly, and that premium doesn't need a war to exist. Just the belief that enforcement can happen, unpredictably, anywhere. That belief is now established. The lesson landed. Every oil exporter received the message. Leave dollar system at your own risk. Not economic risk. Physical risk. Leadership risk. This lesson doesn't require confirmation. It requires plausibility, and plausibility exists. So the capture itself, that's the headline. The signal, that's the weapon. The barrel is the headline. The rail is the weapon. And the rail just got electrified. 3 lanes of consequences, all happening simultaneously. Lane 1, oil market effects. Volatility increases, not just price level. Price variability. Traders' price uncertainty. Uncertainty means wider spreads, wider bid-ask, less liquidity at extremes. This becomes permanent feature, not temporary shock. Benchmark spreads affected. Brent WTI differential. Heavy light crude differentials. Regional discounts and premiums. All repricing based on route risk. Venezuelan heavy discount, $15 to $28. Mexican Maya, $12 to $20. Canadian heavy premium, $5 to $9. Iranian light discount, $20 to $35. New risk floor established. Even when headlines fade, floor remains, because memory of enforcement possibility doesn't fade. Lane 2, dollar system effects. Short term, compliance pull likely. Strengthens dollar settlement temporarily. Countries and traders prefer safer channels, even at higher cost. This increases dollar usage. In oil transactions, dollar share of oil trade was declining from 90% in 2020 to 82% in 2025. January 2026 operation likely reverses trend temporarily, back to 85 or 86%. Short-term positive for dollar demand. Long-term, fragmentation acceleration paradox. Showing system requires enforcement. Reveals coercive nature. Countries beyond enforcement reach. Accelerate alternatives. China, Russia, building systems. Outside U.S. jurisdiction. Blockchain-based settlement. Decentralized networks. Gold-backed bilaterals. Can't be frozen. Can't be seized. Can't be enforced against. Enbridge processing increases. From $12 billion annually, projected $50 billion by 2027. BRICS Pay adoption accelerates. Digital yuan oil contracts. Scale faster than expected. This is the paradox. Enforcement in one area drives innovation in others. Strengthens system short term. Weakens it long term. Creates exact alternatives. It meant to prevent. Lane 3. Geopolitical contagion. Every oil exporter recalculating risk assessment, contingency planning, alternative arrangements. Not publicly. Quietly. Saudi Arabia, watching closely. Already testing yuan for 15% of China sales. But carefully, balancing U.S. security relationship against economic diversification. UAE, balancing act intensifies. BRICS member since 2024. U.S. strategic partner. Major oil exporter. Walking tightrope. Nigeria, Angola, Kazakhstan. Exploring options quietly. Not challenging openly, but asking questions. Building relationships. Testing alternatives. Mexico, Canada, close to U.S. geographically. Less room to maneuver, but even they're calculating. What happens if commodity price disputes? Political tensions. Could this happen here? Every producer now has primary plan. Maintain dollar relationships. Contingency plan. Alternatives on standby. Just in case. This is how systems break, not with a crash. By rerouting, one connection at a time. until the map looks different, and nobody remembers why. But everyone remembers the risk is real, and visible, and possible. Let me game out 3 futures. All conditional. Scenario 1, compliance shock. Base case scenario, what happens? Operation successfully deters further fragmentation. Countries testing alternatives pause. Too risky now. Dollar settlement share stabilizes or increases. 85 to 88% of oil trade. Treasury demand holds. U.S. Funding advantage maintained. 3 triggers for this. First trigger. New Venezuelan government proves stable and returns to dollar sales within 6 months. Second trigger. No major oil exporter defects to yuan systems through 2027. Third trigger. China and Russia don't provide effective security guarantees to alternative-seeking producers. One consequence, petrodollar extends another decade. System held together by visible enforcement. Not economic strength, but holding nonetheless. Risk premium, embedded but manageable. Scenario 2, shadow expansion. Bear case. What happens? Enforcement drives innovation around it. Countries can't challenge directly, so they build outside reach. Shadow systems scale significantly. Cryptocurrency settlement increases. Gold-backed bilateral deals proliferate. Barter arrangements expand. All outside visibility. China's Enbridge processes significant volume, 50 to 100 billion annually by 2028. Digital yuan oil contracts. On blockchain. No SWIFT involvement. No U.S. oversight. Dollar share of oil trade declines from 82 to 65% by 2028. 3 triggers for this. First trigger. China provides explicit security guarantees to oil exporters using yuan systems. Second trigger. Alternative payment systems prove reliable at scale with minimal technical failures. Third trigger. U.S. Enforcement creates more international resistance than compliance. One consequence. Bifurcated global oil market emerges. Dollar system for aligned producers. Alternative systems for others. U.S. Funding costs rise gradually. 5 to 10 basis points annually. Cumulative effect. Significant. Scenario 3. Energy inflation feedback loop. Chaos case. What happens? Operation triggers unintended cascade. Multiple stress points converge. Major oil exporter makes unexpected move. Saudi Arabia shifts dramatically to yuan. 50% of China sales. Not 15. Or other large producer defects. UAE follows. OPEC fragments overpayment preferences. Oil markets panic. Prices spike to $120 to $140. Risk premium goes vertical. Not just Venezuelan crude. All grades affected. Supply concerns compound. Dollar crashes as foreign holders exit treasuries. Faster than expected. China, Japan, Saudi selling. Yields spike to 7 or 8%. U.S. faces funding crisis. Fed must choose between bad options. Print money to buy bonds creates inflation spiral. Let yields spike. Creates deep recession. No good choice. 3 triggers for this. First trigger. Major unexpected defection from dollar system by key U.S. aligned producer. Second trigger. Oil price shock above $120 combines with treasury sell-off. Third trigger. Fed credibility questioned simultaneously by inflation and growth concerns. One consequence. Rapid, multipolar transition. Dollar loses reserve dominance within 36 months. Energy inflation becomes structural. 8 to 12% annually. Standard of living adjustments. Import costs surge. Social instability follows. Which scenario unfolds? Depends on signals, not speeches. And now you know what to watch. 5 indicators. Track these carefully. Indicator 1. Tanker insurance rates and shipping indexes. Lloyd's publishes war risk premiums monthly. Baltic Dry Index shows shipping costs daily. Watch for Venezuelan route premiums. If spike persists beyond 3 months, flow damage is structural. If normalized within 6 weeks, temporary shock. Similar profile route premiums. If spread to Iranian, sanctioned adjacent routes, contagion happening. If contained to Venezuela, isolated event. Check monthly for trends. Indicator 2. Seizures and enforcement actions. Watch for pattern expansion. Not just Venezuela. Asset freezes on intermediary companies. Sanctions on trading firms. Tanker interdictions in international waters. Each action signals doctrine scope. If actions increase, enforcement expanding. If actions plateau, deterrence achieved without escalation. If actions decrease, temporary measure. This tells you enforcement strategy. Whether one-time or systemic shift, check weekly. Indicator 3, benchmark spreads. Brent WTI spread. Normal range, $2 to $8. If widens beyond 10, North American supply stress, Brent Dubai spread, normal range $1 to $3. If widens beyond 5, Asian demand or Middle East supply issues. Heavy light crude differentials, Venezuelan heavy discount specifically. If stays above $25, market doesn't believe stability. If narrows to 15, normalization. Mexican Maya, Canadian heavy spreads. If widens significantly, contagion to similar grades. If stable, Venezuela isolated. Check weekly. These spreads tell you whether market believes this is temporary or permanent. Indicator 4. Reserve composition trend headlines. IMF publishes global reserve data quarterly. COFR database. Dollar share of allocated reserves. Watch for decline. Currently around 58%. If falls below 55, major shift underway. If stable, system holding. Also watch. Central bank gold purchases. If surge above historical average, flight from paper currencies, yuan reserve accumulation. If accelerates, alternative gaining traction. Check quarterly on IMF release days. These show long-term confidence in dollar system, or lack thereof. Indicator 5. USD funding stress signals. Fed swap line usage. Available on Fed website weekly. If foreign central banks draw heavily, dollar shortage. Good for dollar short term, but indicates stress. Repo market rates. SOFR and secured overnight financing rate. If spike above 5.5%, funding stress. If calm below 5%, system absorbing shock. SOFR-based spreads, difference between secured and unsecured. If widens beyond 50 basis points, credit concern. If tight, confidence remains. Check daily for funding markets. Critical during stress periods. These tell you whether plumbing is functioning or starting to clog, because the plumbing moves first. Before headlines. Before analysis. Before everyone knows. Plumbing shows stress. In rates and flows, not words. By the time headlines catch up, wallet's already moved. Too late to position. So watch the plumbing, not the politics. Let me bring this home. The target wasn't Maduro. Whether he's in custody or not, whether operations succeeded or failed, confirmed or disputed, doesn't matter. For oil systems, the target was the belief. The belief that you can move oil outside dollar settlement without consequences. For 6 years, Venezuela proved you could, survived sanctions, built workarounds, functioned despite pressure. 800,000 barrels daily through shadow routes, through intermediaries, through non-dollar settlement. It worked. Others watched. Iran saw. Russia learned. Saudi Arabia tested. BRICS discussed. The belief was spreading that dollar settlement is optional, not mandatory, that enforcement is economic, not physical, that you can build alternatives and survive. January 3rd, 2026 ended that belief, not by stopping Venezuelan oil, by making the cost visible, enforcement risk, leadership risk, physical risk, insurance repricing, route cancellation, compliance tightening, all happened within 24 hours, regardless of legal outcome, regardless of confirmation. The signal landed. That belief is now shattered, replaced by different belief. Dollar settlement carries protection. Alternative settlement carries risk. Risk you might not survive. This changes calculations. For every producer, Saudi Arabia recalculating, UAE hedging, Nigeria exploring but carefully, every trader reconsidering, gray zone transactions rejected, compliance thresholds raised, every intermediary withdrawing. From anything enforcement adjacent, risk not worth reward. Even if technically legal, this is structural damage, not headline damage. The capture is disputed. The damage is done. 2 questions for you. Drop answers in comments. Question 1. Does enforcement slow fragmentation or accelerate it? Short-term compliance versus long-term resistance. Deterrence versus innovation. Which force wins? I want both sides. Bull case. Enforcement works. Dollar dominance extends. Bear case. Enforcement reveals coercion, accelerates alternatives. Question 2. If you ran a major oil exporter, what's your contingency plan? Stay in dollar system fully? Build alternatives quietly? Hedge with both? How do you balance? Security relationship with U.S. against economic diversification? No right answer. Only trade-offs. Leave your analysis below, because this isn't politics. This is plumbing, and plumbing has consequences that last years, not news cycles. Final thought. The capture is a headline. Disputed or confirmed. Real or exaggerated. Legal or illegal. Doesn't change the oil damage. The oil damage is structural. Insurance repriced. Routes rerouted. Settlement preferences shifted. Intermediaries withdrawn. Compliance tightened. Risk premium embedded. Tanker captain out of work. Refinery costs increased. Gas prices affected. Inflation transmitted. All within days. And it's already done. You can't unreprice insurance. Can't uncancel routes. Can't unshift settlement preferences. The system changed. January 3rd. Whether Maduro is in custody or still in Caracas, the oil damage is structural, is permanent, is done. If you want to see what's next, subscribe. Hit the bell. Because oil markets move faster than politics. And the next shock won't come from Caracas. It will come from settlement rails, from insurance recalculations, from compliance departments you won't see on news until it's already priced. And by then, your gas price already changed, your inflation already transmitted, your wallet already affected. Thanks for watching Financial Rewind. I'll see you in the next one, where we trace how compliance decisions become inflation reality, and why risk premium never goes back to zero once enforcement becomes visible